The U.S. stock market just lost $4 trillion in value. From the U.S.-China trade war to the Canadian tariff battle and rising consumer prices worldwide, the world is in economic turmoil. So, are we on the verge of a full-blown global recession? But what's causing all this chaos? In this video, we'll break down the trade war chaos and why the U.S. is clashing with China, Canada, and beyond, Trump's tariff strategy and whether it can really boost economic growth, why are investors backing out, and what this means for jobs and markets, and most importantly, what this means for you. During the 1980s and 1990s, China underwent a dramatic transformation, shifting from a state-controlled economy to the world's go-to manufacturing hub. Under Deng Xiaoping's leadership, China embraced market reforms, opened its doors to foreign investment, and became the preferred destination for global production. American companies rushed to move their factories overseas, lured by China's cheap labor and low production costs. The real game-changer came in 2001 when China joined the World Trade Organization, gaining unrestricted access to global markets. Exports skyrocketed, fueling a staggering 700% GDP increase in just 15 years. By the 2010s, China had evolved beyond being just a low-cost manufacturing hub. It had positioned itself as a global technological and economic powerhouse. The United States viewed China as an economic threat for several reasons, with the growing trade deficit being one of the primary concerns. By 2018, the U.S. was importing far more from China than it was exporting, leading to a record-breaking trade deficit of $419 billion. This deficit resulted in a loss of millions of U.S. jobs, especially in the manufacturing sector. American policymakers saw this imbalance as a sign that China was benefiting disproportionately from global trade, often at the expense of U.S. manufacturing jobs. Another major flashpoint in the U.S.-China economic battle has been intellectual property theft. According to the U.S. Trade Representative's Section 301 investigation, they found that Chinese theft of American intellectual property costs between $225 billion and $600 billion annually. Micron, a U.S.-based leader in memory chip manufacturing, had its technology stolen by Fujian Jinhua, a Chinese company. Fujian Jinhua worked with employees from United Microelectronics Corporation, known as the UMC, a Taiwanese semiconductor foundry that partnered with Fujian Jinhua to steal Micron's technology. In 2020, UMC pleaded guilty to criminal trade secret theft and agreed to pay a $60 million fine. But in 2024, a U.S. federal judge dismissed charges of economic espionage against Fujian Jinhua, ruling that prosecutors failed to prove the company directly stole Micron's technology. Beyond this, China had invested heavily in emerging fields such as artificial intelligence, 5G networks, and semiconductors, positioning itself as a global leader in industries that the U.S. had long dominated. The expansion of Chinese tech giants like Huawei and Tencent alarmed American officials who worried that China's technological dominance could weaken U.S. influence and even pose security risks. Therefore, in 2018, U.S. President Donald Trump declared an economic war on China. Trump imposed tariffs on $60 billion worth of Chinese goods. China retaliated with tariffs on American soybeans, cars, and aircraft. Farmers in the U.S. Midwest were hit hard as China stopped buying U.S. agricultural products. In 2019, the U.S. banned Huawei, a leading Chinese global provider of information and communications technology, from working with American companies, cutting it off from crucial technology like Google services and U.S.-made chips. This trade war left foreign investors to leave China and move on to countries like Vietnam and India. The U.S. restricted China's access to advanced semiconductor technology, fearing competition in AI. China expanded its partnerships with Russia, Middle Eastern countries, and BRICS nations. The U.S. and China signed a Phase 1 trade deal in January 2020. China agreed to increase purchases of U.S. goods and services by $200 billion over 2 years, but ultimately fell short of this commitment. As of March 2025, the U.S. has imposed a 20% tariff on Chinese imports. This increase occurred on March 4, 2025, when the existing 10% tariff was doubled. In response, China has imposed its own tariffs on U.S. goods, including agricultural products like chicken, wheat, and soybeans, with rates ranging from 10% to 15%. But it's not just the U.S. and China. On February 1, 2025, Trump signed executive orders imposing a 25% tariff on all goods from Mexico and a similar tariff on most goods from Canada, with a 10% tariff on Canadian oil and energy exports. Canada and Mexico responded with retaliatory measures. Canada imposed tariffs on $30 billion worth of U.S. goods, with plans to expand this to $155 billion. Trump has threatened to increase tariffs further after April 2nd and has mentioned imposing new tariffs on Canadian lumber and dairy products. Back in 1994, the US or Canada and Mexico signed NAFTA, the North American Free Trade Agreement. The goal? To eliminate trade barriers and boost economic growth. But not everyone was happy. Trump called NAFTA a disaster, arguing that it shipped American jobs overseas and gave unfair advantages to Mexico and Canada. His solution? The USMCA, a new trade deal designed to fix NAFTA. The USMCA modernizes NAFTA by addressing new areas like digital trade, strengthening labor and environmental protections, and adjusting rules for key sectors such as automotive and agriculture. Trump announced that products compliant with the USMCA would be temporarily exempt from these tariffs until April 2, 2025. The USMCA is set for review by July 2026. The review will determine whether the USMCA is extended for another 16-year term. If not, the agreement will terminate in 2036, creating uncertainty for investors and businesses reliant on North American trade. Billions of dollars are being pulled out, and hedge funds are dumping stocks. Every time a new round of tariffs is announced, the stock market reacts violently, plunging investors into panic mode. Just recently, the Dow Jones dropped nearly 900 points in a single day as fears of an economic slowdown intensified. Investors aren't just worried about tariffs, they're also nervous about the Federal Reserve's next move. In the past, when markets struggled, the Fed would step in, cutting interest rates to stimulate the economy. But with inflation still running high, that safety net might not be available this time. Without a bailout or economic cushion, investors are looking for safer places to park their money, pulling billions from stocks and shifting to assets like gold and government bonds. Despite the market turbulence and warnings from economists, Donald Trump remains defiant. He claims that he doesn't even look at the markets because, in the long run, the U.S. would be very happy with the results. Tariffs aren't just a short-term inconvenience. They fundamentally reshape economies. Even after they are lifted, the changes in supply chains, pricing structures, and consumer behavior often persist. The result? A permanently higher cost of living for everyday people, reduced purchasing power, and long-term changes in how businesses operate. When markets crash, retirement savings shrink, companies cut jobs, and consumer confidence takes a nosedive. U.S. employers announced 172,017 job cuts in February 2025, marking a 245% increase. The federal government has laid off about 62,530 workers in the first 2 months of 2025. When production costs rise, companies may cut jobs, freeze wages, or relocate to cheaper regions. For example, when tariffs on Chinese components raised costs for U.S. tech companies, some firms outsourced jobs to Mexico or Southeast Asia instead of expanding domestic hiring. If China sells steel to the U.S. at $500 per ton and Trump slaps a 25% tariff on it, that steel now costs $625. In theory, this makes American steel more competitive, boosting local jobs. Sounds great, right? But there was a catch. When a country imposes tariffs on imports, businesses that rely on these goods must pay higher prices, and companies pass them on to consumers. For example, when the U.S. imposed tariffs on Chinese steel and aluminum, American companies manufacturing cars, appliances, and canned goods had to pay more for raw materials. This led to price hikes on everything from vehicles to soda cans. So, what happens now? Some economists say tariffs will push us into a global recession. Others argue that new trade deals will eventually balance things out. But one thing is clear, these trade wars have changed the world economy. If tensions continue, companies will keep cutting costs, which means more job losses and higher prices. But if agreements are made, global trade could recover. The question is, will leaders compromise, or will they double down on economic battles? What do you think? Are tariffs necessary to protect local industries, or are they doing more harm than good? Drop your thoughts in the comments below, and don't forget to like, share, and subscribe for more insights on the biggest economic shifts happening right now.